Hi everyone, I'm Paul and welcome to my review of ICT's 2022 YouTube Mentorship Program, Lesson 10. Today's video builds on Lesson 9, so if you haven't checked that one out yet, you should definitely watch that one first. I've been getting lots of supportive comments for these videos, so please keep sending those through. I'm really appreciative for them and I try to respond to every one. These videos really help me to consolidate my learning, so I'm really glad to hear that they're helping other people as well. But of course, make sure you check out ICT's channel so you go straight to the source for his YouTube mentorship program. I'll put a link in the description to save you a little bit of time, so make sure you subscribe to his channel. So please like, subscribe, and let's jump into today's video. Today's video is Lesson 10 of ICT's 2022 mentorship program. And we'll just start with a quick outline as we do in every video. So the first section of the video will be on the importance of the economic calendar. We'll go over ICT's Power of 3 again, which is building on Lesson 9. Talk a little bit more about the opening range, and then do a deep dive on daily bias using the NASDAQ daily chart. And then we'll finish off with applying the Power of 3 and the opening range to economic events. And again, we use the NASDAQ as our trade example. So the first part of the video is the importance of the economic calendar. Now, if you're doing any kind of speculation on markets, especially if you're trading index futures or currency, then you definitely need to be aware of economic events. So there's lots of economic calendars out there, and one of the most commonly used is forexfactory.com, and this is the one that ICT uses and he recommends you use as well, but there's plenty out there. Forex Factory is the one that I use, and one of the reasons I like it is that they color code the news event based on the predicted price impact. And so that's obviously yellow to red, with red being the most impactful price event. Generally, news events will be released at around 8:30 New York time. And so it's just a good practice to be constantly monitoring that economic calendar so you're aware of any events that are going to be coming out in the near term. My view is that the shorter a time frame you're looking to trade on, the more important some of these news items can be, because they can be quite volatile either at the time that they come out or pre or post the release of that information. So certainly if you're trading on very short time frames, you definitely want to be aware of these news events, because they can create big whipsaws in price, which can obviously stop you out of positions or take you out of profitable positions, or switch positions which were profitable to not profitable. And so just keep in mind that news events can be used as a smokescreen or for a catalyst in price. And so you'll commonly see a fake move prior to the announcement, followed by the real move afterwards. So we touched on the Power of 3 in Lesson 9, but we'll go into a lot more detail in this video on Power of 3, just because it specifically refers to the daily time frame, and it's particularly important in how we apply our bias to the daily chart. And so the reason why the Power of 3 is important is because when we're applying our daily bias to the chart and we're trying to anticipate what price is going to do, it helps us to anticipate what price might do given our particular bias. So if you look at the chart, we've got basically a bearish and a bullish candle. And if we use our bias as a lens, we can then apply the Power of 3 to each of these candles. So if we start with the bearish bias, and just remember with Power of 3, it's 3 stages. So we have accumulation, manipulation, and distribution. And these are obviously the inverse for bearish and bullish bias. So if we start with the bearish bias, we've obviously got a down close candle where we have the open, we have the high, and then we have the close and then the low. So when we apply Power of 3 to a bearish candle, we have accumulation at the open and between the open and the high. So this is where smart money is getting their position set in advance for a move downwards. So this is the manipulation, the move downwards. And then we have distribution, which is distribution of those short positions here during this accumulation phase between the close and then the low. And so if we're looking at the daily chart and we had a bearish bias, then we'd expect the market to open, trade higher, and then trade lower. So that would be the manipulation phase. We would then have a significant low formed at some point in the day, probably towards the end of the trading session before closing. Now, it's not obviously going to look exactly like that every time, but it kind of gives us a roadmap for what we expect price to do if we have a bearish bias. And it's the opposite if we have a bullish bias. Remember, the power of three is accumulation, manipulation, and distribution. And so when we have an up close candle and we're applying a bullish bias, so we have accumulation here between the open and the low, and this is where smart money is getting set in their long positions. We then have manipulation of the price higher. We then have a meaningful high painted towards the end of the session again, before the market closes lower. And then we have the distribution phase between the close and the high. And this is where the smart money positions are exiting their long positions from the accumulation phase. So again, if we're looking at the daily chart and we're expecting higher prices because we have a bullish bias, we're going to anticipate that the market will open, trade lower during that accumulation phase. We'll then trade higher through the manipulation phase, and then towards the end of the session, we'll make a meaningful high before closing lower. And so again, if we're applying a bullish lens or a bias to the market, this is the type of price action that we're going to be expecting to see. We're going to expect to see an up close candle where we open, trade lower, trade higher, and then close below the high. And keep in mind that the power of three applies to the daily time frame and specifically in terms of our bias. So the opening range is like a layer that we put on top of our bias and the power of three. So again, we have two separate lenses to look at our opening range in terms of a bearish bias and a bullish bias. And what we're effectively doing is looking at the accumulation phase of the power of three and then applying a range which gives us the area that we're going to look at for our trade entries. So if we have a bearish bias, remember we're expecting the open to the high, so that's where our accumulation is going to be. And so this is where smart money is going to be getting set in short positions prior to the manipulation phase and then the distribution phase down here at the lows and the close. And so the opening range is the distance between the open and the high. So we take that range and then we effectively double it. So we add that range from then the open lower, and this gives us the total range. So we're effectively got this whole zone here to look for trade setups if we're anticipating lower prices. So remember, we're going into the market with a bearish bias, so we're expecting lower prices. We have the power of three, so we're expecting the market to open and trade higher before going lower. And so that's going to give us then our opening range. So between the open and the high, we add that range below the open, and we're going to find our optimal setups in this area here to get us positioned for that move lower before we have distribution at the lows. And the opposite's obviously also true if we have a bullish bias. So remembering our power of three, we're going to be expecting the market to open and trade lower. And so this is again going to be our accumulation phase. So this is where smart money is going to be trying to get positioned long for that move upwards before we have distribution between the close and the high. So similar to the bearish setup, we're going to have a range between the open and the low, and we simply then add that range from the open upwards, and this gives us our complete opening range. So this range is going to allow us to find setups in that range, which is going to allow us to take advantage of our bullish bias in anticipation of that manipulation and then distribution at the end of the session. So you can see how these concepts of having bias, whether it be bearish or bullish, then having a layer of then the power of three on top, which gives us an insight into what the market will do in terms of price on that given day. And then we have the opening range, which within that particular session gives us an area to examine to look for trade setups, which are going to allow us to take advantage of our bias and increase our probability of having a profitable trade. So we've covered daily bias now in 2 lessons. We've looked at the power of 3 and also the opening range. So let's try to put all of those things together and walk through the daily chart on the NASDAQ. So if we kick off at this swing low here, now remember a swing low is a candle which has a low which is lower than either of the candles below it. So you can see this candle is lower than both of these candles here, and this swing low or this intermediate low takes out this sell side liquidity And so from here, we'd anticipate that we might see the market trade higher again. So we obviously have a bullish bias. So if we apply our ICT power of 3, we're expecting the market to open, trade lower before trading higher, and then closing below the high. So you can see that's what we have here. And then the next candle does the same thing. It's not exactly the same candle. It's not a neat candle like we had in the slide. It has a much larger wick, but you can see it's still bullish. We open, trade lower, obviously significantly lower before trading higher. And you can see the close is quite close to the high there. Now you'll note we have a fair value gap above this, so we have a bearish fair value gap. I've started color coding those pink to delineate them between the bullish fair value gaps. So we'd anticipate that price is going to continue to draw into that fair value gap. So it's going to act like a magnet to price. And that's exactly what happens in this next candle here. You can see that the market opens, it doesn't trade lower at all, it just trades straight up. It wicks right into that fair value gap before closing below it. Now, because we've traded into that fair value gap, you'd anticipate that we may trade lower as a result. Now, if we don't and we continue to trade higher, that's not a big deal. That's obviously why we use position sizing and risk management if we get it wrong. But because we've traded into this fair value gap, we'd anticipate that the market might trade lower. Also, if we run a fib from the low to the high in this particular range, so we take the down close candle before the upward move right to the high, we can see that we're trading now in a premium market, and so we'd expect the market to now trade lower, potentially back into a discount or towards equilibrium. And that's what happens. So we again don't have a perfect power of 3 candle. We open, trade higher, there's a much bigger wick here. You can see we trade lower and close almost at the low. So after this bearish candle, we're expecting the price to continue to be bearish and to trade back towards equilibrium, and we get another bearish candle. So again, we open, trade higher before we trade lower, and then we close right down near the lows. So we can see the next candle's also bearish. It's almost a bit of a spinning top formation, so one where there's a bit of indecision, but it's still a down close candle. We open, trade higher, again another big wick before trading lower, and then we close above the lows. And you can see we've now traded back down into a discount, and you can see we've kind of gone into a little bit of a consolidation here. So what we need to do is look at more price action to be able to determine what our bias is going to be. And you can see these next 2 candles are very strong up close candles. So we open at the lows, and this is again our power of 3. So we open at the low, we trade higher, and then we close just below the highs. The next candle, again another powerful bullish candle. We open at the low, we don't really trade lower at all, trade higher, and then close just below the highs. Now this candle is significant because it takes out these previous short-term highs. We've traded back into this bearish fair value gap again, and so there's obviously the chance that we could trade lower, but keep in mind we've taken out this short-term low, we've traded into this fair value gap, which is obviously acting as a bit of a magnet for price. We've taken out these short-term highs here, and then we'd anticipate that the market is going to continue to be drawn towards this high here and then eventually these highs here. So remember, this is where we have our buy side liquidity here because we have stops that reside here. They have buy stops, and so we'd anticipate that the market is going to continue to attack these. So we have a bullish bias, which means if we apply the ICT power of 3, we're going to anticipate that we're going to have a series of up close candles where we open, trade lower before trading higher, and then closing below the highs. And you can see if we look at this sequence here, we have a whole series of these candles. Now they're not obviously all perfect, but in this run you can see we only have 3 down close candles in this whole move. So obviously if we have a bullish bias in this period and we're applying our ICT power of 3 and our opening range, we're going to be looking at buy setups in that period from the open to the low, and then obviously that period above that, and that's where we're going to be finding those long setups during this whole period. Now obviously if you take a long position in some of these down close candle days, doesn't necessarily mean that you would get stopped out, but you could obviously take a loss on these days. That wouldn't negate your bullish bias for this particular move. So we just need to be realistic about that and not let one or two trades knock us out of our zone. So you can see after we take out these relative equal highs, the market continues to trade higher and it just continues to accelerate. And you can see a lot of these candles are much more expansive. So we have accumulation and distribution just occurring day after day after day. So after we take out these relative equal highs here, we go into a consolidation phase where we just need to look for more price action to be able to redetermine what our bias would be. So I personally find these consolidation periods a little bit tricky. You obviously have periods where you may have fair value gaps being set up in either direction before the market really picks one and just goes in that direction. So you can see in this phase here, there's a clear bullish fair value gap that forms just here. So you can see this 3 candle formation we have here, and these expansive candles break market structure there. But you can just see the market trades back down. If you had your stop here, it would have been stopped out, even though the market retraces higher here, taking out these highs. And so that obviously would have been a bit of a false start before we get this more definitive bearish move here. And so after this consolidation, you can see this bearish setup is quite clear. So we have our 3 candle formation here. You can see the bearish fair value gap is formed here between the low of that first candle and the high of this 3rd candle. The market trades back up into that, and then you can see we have bearish market structure pretty much the whole way through. And in this whole move, we only really have 2 up close candles before we consolidate. And so just the opposite of what we had in this bullish phase here, in the bearish phase, we're looking at the opposite. So still applying ICT's power of 3 and opening range to our bearish bias. So we're going to be expecting an open trade up into the high before the market trades lower and then closing above the lows. So we have accumulation at the open to the high, then manipulation, and then distribution from the low to the close. And so we're expecting to see that in terms of the down close candles as the market trades lower. So you can see after we trade up into this fair value gap, we have this bearish candle here. So applying ICT's power of 3, we would have the open, trade higher. This is our accumulation phase. And remember, if we're applying our opening range, we would then have our short setups forming between the open and the high, and then applying that range from the open and lower. And we would find all of our short setups there. We'd have manipulation, so price trades downwards, and then we would have distribution between the low and the close. So again, as we had with our bullish setup, if we do have an up close candle in our bearish bias, it doesn't necessarily mean that we can't have a profitable trade there. But if we don't, it doesn't knock us out of our bearish bias. It's just part of trading that sometimes you will have trades that go against you, and that's why you obviously have position sizing and money management, so that one trade isn't harmful to your account. But you can continue to see we have the power of 3 and our bearish bias continue to be in play as we trade lower. So again, we open, trade higher where we have accumulation, we then have manipulation and then distribution at the low and the close. And we have this pattern repeat until we take out that previous low that we were talking about earlier in the video here. So we take out this sell side liquidity, the market trades lower down into it. And so after we've taken out this sell side liquidity, we're expecting the market to retrace, which is going to give us our range. So again, as we did before, we run our fib from the low to the high, and that gives us our range. So we have our premium and our discount market. And so in this example, the market's consolidating, but we don't have anything to suggest a change in bias. And so our bearish bias still remains intact. And so the market trades from this discount into the premium back towards equilibrium. You can see it makes a short-term low here before trading back into a premium market again. And then as it trades back into a discount, it creates this fair value gap here. Now that fair value gap and this 3 candle formation, so 1, 2, 3, we can see that it takes out this short-term low and breaks market structure. This candle here is also a spinning top, so that's like an indecisive candle where the market is trying to decide whether it should trade higher or lower. And we have our fair value gap formed above it, so between the low of the first candle and the high of that 3rd candle. And so from here, we'd be expecting the price would trade back up into that fair value gap. So that's going to be like a magnet to price. And it's also quite common to see once price breaks above the high of that spinning top that it'll continue higher. And so that's exactly what happens. And so we get a very strong bullish candle here. So we have our open, trade lower, trade higher, and then we obviously close just below the high. So that's a very classic power of three candle. And then you can see the next candle trades. The next candle is an up close candle, a very small one. And you can see it completely fills out that imbalance and trades the whole range of that fair value gap. So remember, we still have a bearish bias. We've now traded back into a bearish fair value gap. We've completely closed out that imbalance. And so we'd expect lower prices from here. And that's exactly what happens. We get this very strong down close candle. Again, looking at our ICT power of three, we open, trade higher before trading lower, significantly lower, and then closing just below the low. So we have our accumulation of shorts, our manipulation, and then our distribution of those shorts at the low and the close. So we've now traded back into our discount part of the market, and we're anticipating that price is going to take out these previous lows here. And so our bearish bias continues now until proven otherwise. So now we're going to take everything we've learned from bias, ICT power of three, and the opening range and apply it to a news event which is going to come out at 8:30. So we're going to use the 17th as our example using the NASDAQ as we've been doing all throughout this video. And so remember, coming into the 17th, we have a bearish bias. And so we're starting now on the 1 hour chart, and you can see this pink box here is that fair value gap, so that bearish fair value gap that we have from the daily chart. And so I've just outlined the beginning of the session. So we have midnight here, New York time, and then we have the London kill zone here, which is from 2 o'clock to 5 o'clock New York time. And so you can see here in the Asian trading session, so we're on the 1 hour chart here, we have another bearish fair value gap which is formed here. So we now have confluence between a higher time frame on the daily chart and now a lower time frame on the 1 hour chart. You can see as we go into that London session that the market trades back up into that fair value gap, so we'd have plenty of opportunities to get set in that particular session. So before we go on, just remember our power of three. So it's accumulation, manipulation, and distribution. So in this example, we're bearish, so we're expecting a down close candle. So we're expecting an open, a trade higher, then manipulation lower, and then distribution between the close and the low. So remember, our opening range is the distance from the open to the high, and then we just mirror that range lower, so that gives us that whole area that we're going to be looking for short setups to take advantage of this move lower. So just keep that in mind as we zoom into now the 15-minute chart to start to look for trade setups to take advantage of our bearish bias and the news event, which is going to come out at 8:30. So on our 15-minute time frame now, you can see we have our bearish fair value gap from the daily range, and we then have that overlaid with our bearish fair value gap from the hourly chart. And you can see how we start to get confluence between these various time frames. You can see on the 15-minute chart, we have another bearish fair value gap, which is formed just here, and then another one which is formed here inside that London zone. But going back to our power of three, we've got our open here, the New York open at midnight, and we have the opening price here. So remember, with our power of three, especially when we have a bearish bias, we're expecting accumulation between the opening price here and the high. So at this point in the session, the high is up here. So this is where we're expecting smart money to accumulate short positions. And if we're going to apply our opening range, remember we're going to mirror the range from the open to the high, lower, and then we're going to have a whole zone that we're going to have potential short setups to take advantage of the down move that we're expecting at that 8:30 news event. So I'm just going to mark out these fair value gaps on the 15-minute chart. That's going to give us that confluence we're looking for. So we have these overlapping fair value gaps, which is just going to give us a higher probability setup. So I've marked up those additional fair value gaps now on the 15-minute chart, and I've also marked up that 8:30 news event so we can see that on the chart. You can see now as we've moved into this 5-minute chart how we just have this layering of fair value gaps forming on top of the others. So in this big box, we have the daily fair value gap. We then had the 1 hour and then the 15-minute. And now that we're on the 5-minute chart, you can see we have overlapping fair value gaps on this chart as well. So you can see we have one just formed just here, and then another one formed here within that. So these are all within those fair value gaps that were formed on the higher time frame. So this is giving us more and more confluence, leading to a higher probability trade. So you can see if we'd taken this setup here in the London kill zone, we would have had the potential to get set a number of times prior to the news event at 8:30, and then immediately leading up to that news event. So at 8:30 here, you can see there was another opportunity or another setup here, which the market just traded into. And then even immediately after that news event at 8:30, you can see the market reacts quite quickly. We get another fair value gap formed here before the market trades back up into it, coming just back up into the opening price. And you can see this move here took out all of this sell side liquidity here before again trading lower, taking out this previous sell side liquidity down here at this low here. But you can see even if you hadn't managed to get set between the open and the high, so during this accumulation period here where we would have most of the smart money getting set in their short positions, if we apply that opening range, so remember from the open to the high, and we apply that downwards, so you can see there's still a trade entry here on this fair value gap here, which would have allowed you to get set, and that's even after that news event, to take advantage of that particular move. In today's video, we went much deeper into daily bias and specifically talked about the power of 3 and the opening range. We then took all of these concepts and applied them to the NASDAQ, and then applied them to a practical trading example using an 8:30 news event. I hope you enjoyed today's video, and I hope it helped you with your learning. If you did, it'd be great if you could like it. That helps other people to find it. And if you enjoyed this video, make sure you subscribe to my channel. Thanks for watching, and I'll see you in the next video.